One of the most confusing experiences for investors is watching stock markets rise while the economy appears to be getting worse. Headlines talk about layoffs, slowing growth, weak consumer confidence, or even recession fears, yet stock indices keep climbing. This disconnect often feels irrational, but it is actually a recurring and explainable feature of financial markets. To understand why this happens, we need to separate the economy from the stock market and understand how markets really work. The economy describes what is happening right now. It reflects employment, wages, inflation, production, and consumer activity in the present or recent past. The stock market, however, is forward-looking. Prices are not based on today's conditions, but on expectations about the future. By the time economic data looks bad, markets have often already priced it in. Stocks move based on what investors believe will happen next, not what is happening now. This means markets often bottom when the economic news is at its worst. When data keeps deteriorating but does so more slowly than expected, investors begin to believe that the worst may be over. Even if conditions are still bad, the rate of decline matters more than the level itself. Markets respond to changes in momentum, not absolute conditions. Another major reason markets rise during bad economic periods is central bank behavior. When the economy weakens, central banks tend to respond by easing financial conditions. This may include cutting interest rates, slowing rate hikes, or signaling future support. These actions increase liquidity and reduce borrowing costs. Even before policy changes are implemented, markets often rise in anticipation of them. This expectation of easier money can outweigh poor economic data. Liquidity plays a critical role here. When liquidity improves or is expected to improve, investors become more willing to take risk. Asset prices rise not because companies are suddenly performing better, but because capital is becoming more available. This is why markets sometimes rally strongly even while earnings are falling. The market is pricing the next phase of the cycle, not the current one. Valuations also matter. During economic downturns, stock prices often fall sharply. Valuations compress, pessimism rises, and expectations become extremely low. When expectations are already negative, it takes very little good news to push prices higher. Sometimes, simply less bad data is enough. This asymmetry is why markets often recover long before the economy does. Investor psychology is another powerful force. When economic headlines are consistently negative, many investors are already positioned defensively. Cash levels rise, exposure is reduced, and fear dominates sentiment. Once everyone who wants to sell has already sold, selling pressure fades. At that point, even modest buying can push prices higher. Markets often rise not because optimism returns, but because pessimism peaks. Corporate earnings also behave differently from the broader economy. Many large publicly listed companies are global, diversified, and adaptable. They can cut costs, restructure operations, or shift focus to stronger markets. As a result, corporate profits may stabilize or recover even while domestic economic indicators remain weak. Markets care more about corporate resilience than headline economic data. Another important factor is timing. Economic data is backward-looking. Employment reports, GDP figures, and inflation numbers reflect conditions that already occurred. Markets, by contrast, trade continuously on new information and expectations. By the time a recession is officially recognized, markets may already be months into a recovery. This lag creates the illusion that markets are ignoring reality when they are actually anticipating the future. It is also important to understand that markets do not need a strong economy to rise. They need conditions to improve relative to expectations. A weak economy that is stabilizing can be more bullish for stocks than a strong economy that is overheating and forcing policy tightening. This is why markets sometimes rise on bad news. In summary, markets rise during bad economic periods because they are forward-looking, driven by expectations, liquidity, and changes in momentum rather than current conditions. They respond to what is likely to happen next, not what already has happened. Once you understand this, market behavior becomes far less mysterious. The stock market is not a mirror of today's economy. It is a discounting machine for tomorrow's world.